If the Strait of Hormuz shuts down, the global economy will not slowly decline. It breaks instantly. Ships freeze, traders panic, prices spike within minutes. This narrow waterway moves nearly 20% of the world's oil, so one disruption hits every country at once. No warning, no delay. Just immediate global shock. So, how fragile is today's economy? Chapter 1: The world's most important oil choke point. Why does the Strait of Hormuz matter so much? This isn't just another shipping lane on the map. It's one of the most critical economic arteries in the world. Nearly 1/5 of the global oil supply moves through this narrow stretch of water every single day. Think about that for a second. Every fifth barrel of oil used by cars, airplanes, factories, and power systems around the world depends on this route staying open. That means when this route is disrupted, the impact is immediate. Oil importing countries are starting to worry. Markets react within minutes. Traders begin pricing in risk, fear, and future shortages. And it's not just crude oil. Liquefied natural gas and industrial fuels rely on it too. So, when Hormuz slows, the world feels it everywhere. This is where geopolitics turns directly into economics in real time. Chapter 2: When oil exists but can't reach the market. Now here's where things get more interesting. When people hear oil shock, they assume oil has disappeared. But that's not always the case. In many situations, the oil is still there. Wells continue pumping, and storage facilities remain full. The real issue is movement. Oil must travel efficiently from producers to consumers, and when that flow is disrupted, markets react as if supply has collapsed. Tankers can be delayed, rerouted, or stuck waiting. Insurance costs rise, making shipments more expensive. Ports slow down, creating further delays. All of this reduces availability, even if production hasn't changed. And in economics, availability matters more than total supply. If buyers can't access oil when needed, competition increases and prices rise quickly. So, the crisis is not just about how much oil exists, it's about how effectively it reaches global markets on time. Chapter 3: The scale of the shock. When we talk about the Hormuz disruption, we are not talking about a small imbalance. We are talking about a global system shock that can affect 10 to 13 million barrels per day. That level of disruption places enormous pressure on global supply chains, energy markets, and inflation systems. Historically, only a few crises have come close. The 1973 oil embargo, the 1979 Iranian Revolution shock, and the 2022 Russia-Ukraine energy disruption. But this situation is different in one key way: speed. Instead of gradually tightening, the market experiences immediate uncertainty across a critical choke point. Financial systems react before physical shortages even fully develop. So, what happens when millions of barrels suddenly become uncertain in real time? How do global markets price something that hasn't fully materialized yet? And how does a system built on precision daily supply handle sudden geopolitical disruption of this scale? These are the questions driving global energy volatility. Chapter 4: The hidden crisis. Here's the part most people don't think about. Even if the blockade ends tomorrow, the system doesn't instantly return to normal. Why? Because oil markets depend on logistics. Tankers are not sitting everywhere waiting to move on command. They are part of a carefully balanced global shipping network. When routes suddenly change, vessels are delayed, repositioned, or forced into longer voyages. That means shipping costs rise. Delivery times increase. Insurance premiums go up. Some ships become floating storage units, holding oil offshore while waiting for better routes or safer passage. This creates what economists call a logistics bottleneck. And bottlenecks are expensive, because every extra day at sea means higher freight costs, slower deliveries, and tighter market supply. This is why sometimes the economic damage continues, even after the physical route is reopened. The supply chain itself needs time to rebalance, and that delay can keep prices elevated for weeks or even months. In other words, the crisis doesn't end when the blockade ends. Sometimes the second phase is just beginning. Chapter 5: Why oil prices explode. Oil prices don't just move on supply, they move on fear. That's the key. When markets sense instability, they start pricing tomorrow's risk today. Even before shortages occur, prices begin to climb. And once movement starts, speculation takes over. Traders bet on higher prices, pushing momentum further. This is why oil shocks can escalate so fast. Because oil is not just a commodity, it is the foundation of transport, food, manufacturing, and global logistics. So, when oil rises, everything follows. Food becomes more expensive, flights cost more, factories face higher input costs, and suddenly, a regional disruption becomes a global inflation engine. It doesn't stay in energy markets. It spreads into daily life, fast, unavoidable, and deeply felt. Chapter 6. The Demand Destruction Effect. When oil prices stay high, economies begin to adjust through reduced consumption. This is called demand destruction. People drive less, travel less, and cut spending on non-essential goods. Businesses respond by reducing production, lowering output, or delaying expansion. Airlines reduce routes, and logistics companies optimize fuel use. This reduces overall oil demand. While this helps stabilize prices, it also slows economic activity. Growth weakens as industries scale back operations. Institutions like the IMF often reduce global growth forecasts during such periods. Inflation rises while economic momentum falls, creating pressure on households and governments. The system corrects high prices by reducing usage, but this correction weakens global growth. Demand destruction is therefore both a balancing mechanism and a warning signal. It shows that energy prices have reached a level where they directly affect economic behavior across the world. Chapter 7. Winners and Losers. One of the most important aspects of an oil crisis is how uneven its impact can be. Some countries and industries benefit from higher prices. Oil-producing nations can see increased revenues, and energy companies may experience significant profit growth. For them, rising prices can create economic opportunities. But for oil-importing countries, the situation is very different. Higher fuel costs increase import bills, weaken currencies, and drive inflation. Food prices are rising due to higher transportation and fertilizer costs. Governments may struggle to maintain subsidies, placing pressure on public finances. For many households, this translates into higher living costs and reduced purchasing power. The gap between strong and weak economies widens. This is why energy crises often deepen global inequality. The same price increase that boosts profits in one region can create serious hardship in another, highlighting the imbalance within the global economic system. Chapter 8. Why recovery takes time. Even after a disruption ends, recovery is not immediate. Energy systems are complex and require coordination across multiple sectors. Refineries, pipelines, ports, and shipping networks must all be inspected and restored. Any damage or backlog can extend recovery timelines. Tankers must be repositioned, trade routes recalibrated, and supply chains normalized. Even when physical flow resumes, market confidence remains fragile. Buyers often stay cautious, and prices can remain elevated due to risk premiums. Governments may continue temporary policies to stabilize markets. Businesses may delay investments until conditions are fully stable. This means the economic impact continues beyond the crisis itself. Recovery is gradual rather than instant. The system needs time to rebuild trust, efficiency, and coordination. Even when oil starts flowing normally again, the global economy does not immediately return to equilibrium. The after effects linger and shape economic behavior for weeks or months. Chapter 9. The Long-Term Global Shift. This is where the real transformation begins. Crises like this don't just disrupt markets, they reshape global strategy. Countries begin rethinking dependence on a single supply route. Energy security has become a national priority. Diversification becomes urgent, not optional. Investment shifts toward alternative energy, efficiency systems, and new supply partnerships. History shows this pattern repeatedly. Major oil shocks always trigger structural change. Because once vulnerability is exposed, systems don't return to their old behavior, they adapt. So, is this just another temporary shock? Or does the moment global energy strategy permanently change? This disruption could accelerate a shift toward more resilient systems and reduce reliance on choke points like Hormuz. And if that happens, the impact won't just be today's prices. It will redefine tomorrow's global energy order. The Strait of Hormuz shows how fragile global energy really is. One narrow passage controls prices, trade, and stability across the world. When it shakes, everything connected to it moves. The impact doesn't stay local, it spreads everywhere. fast and deep.